Hi everyone, this is Hilda Voskanian with Keller Williams Realty in La Cañada, Flintridge. We're on another episode of Lending Talk with Edwin Davidian with House America Financial, also in La Cañada, Flintridge. Every week we bring you valuable information about the lending industry and the new rates and laws that have changed. So I would like to welcome Edwin. Hi Edwin, thanks for joining us.
Absolutely, it's a pleasure. So
we asked a lot of people on our sites what kind of questions they had about the lending industry, and there's three that stand out. And one of them is with the 5% down payment, what can you buy?
Sure. With 5% down payment, we're talking about conventional conforming loans, and with 5% down, borrowers can buy a property up to $800,000. So if they buy something for $800,000, Hilda, we're looking at a loan amount of $760,000. The conforming high balance loan amount maximum is $765,000. So they can potentially even go buy up to $805,000 with 5% down. And I'm glad you asked that question because it's because everyone thinks that in this COVID area, maybe they have to put 20% down, but with 5%, they can purchase a property up to $805,000. Of course, they will have PMI, but we will do one loan and that will be it. But that's fantastic with $805,000 with 5% down. Yes.
Okay, and then if they want to buy something more than 800, what's the minimum down payment they can put, and what's the highest amount of loan that they can get?
I think after 5%, we're not talking about FHA right now because FHA is 3.5% down for single family house with a maximum loan amount of $765,000. But we're talking about conventional loans right now. With conventional loans, after 5%, let's go up to 10%. With 10% down, they can potentially buy up to $1.4 million. $1.4 million with 10% down. And what we'll do in that case, Hilda, we'll do two loans. One loan for $765,000 and a second loan for $500,000, and they don't have to pay PMI as well. So that is really, really powerful with 10% down, because when a loan it's above $765,000, it becomes a jumbo loan. Right. Okay. And most banks and most financial institutions, they will require 20% down. So if somebody wants to buy $1 million worth of property, they have to put 20% down if they want to do a jumbo loan, because it will be an $800,000 loan. But if they only have 10%, yes, we can do it. We will give them two loans. So that's a very, very powerful tool to have. Yes.
So will they have the ability to pay off the second loan sooner if they have?
Absolutely. And as a matter of fact, it's a fantastic question because it's a home equity line of credit. And for example, for folks that they have a property to sell and they want to buy a property, right? And if they get the home equity line of credit, once they sell their existing property and they get cash out from that property, the net proceeds, they can pay down their home equity line of credit and they can pay it off as well. And something that is really beautiful about home equity line of credit, once you pay it down or you pay it off, you could reuse it. So you could use this home equity line of credit for the first 10 years. So if somebody has a $500,000 home equity line of credit, but let's say they bought this property for $1.4 million, they put 10% down, and they have a $500,000 of a second home equity second, right? They sell their existing property and they get $200,000 net proceeds. They can take it down and pay down the home equity line of credit that they had for $500,000. They could pay it down by $200,000. So, and the payments on the home equity line of credit is interest only. So now they have $300,000 that they could pay down, and they can concentrate on paying that off. And let's say they pay that off and now they want to buy a car. Well, they can write a check and then buy the car, and so they can use that home equity line of credit, not just buying a car, but if they want to buy another property, an investment property, they could always use that home equity line of credit.
Okay, so is it true that they only pay the payments and the interest on the portion that they've used, or do they pay a payment on the entire amount?
No, they only pay the payment, the interest only payment on the amount that they have used. So let's say somebody has a $500,000 line of credit, and a home equity line of credits, they work with a US prime rate. The prime rate right now is at 3.25%. So let's say that someone's interest rate on home equity line of credit, let's say it's 5% interest only. So you take $500,000, $500,000 times 5% divided by 12. So the monthly payment, it will be $2,083. So that's on $500,000.
Okay.
But in the example that I gave you, let's say the borrower pays off the home equity line of credit by $200,000. Now their balance is $300,000. So you take $300,000 times 5% divided by 12. The minimum payment will be $1,250. So yes, you pay, your minimum payment is due on the balance existing on your home equity line of credit, and it's interest only. You could pay more, which that would be fantastic, because if the minimum payment is interest only, even if you pay $500 more, that goes towards principal, and your next month's payment will be $10, $20, $30 less. So I think that's a great tool for people to have, a home equity line of credit.
That's a fantastic tool for people to have. Thanks for sharing that, Edwin.
Absolutely. Yeah.
So are there any new changes since we spoke last week in the lending industry?
I don't know if we've talked about the big change that came about last week. It was the for self-employed borrowers. For self-employed borrowers, in the past, well, until last week, okay, we never asked to see bank statements in order to verify their income to see if it's at par with their, for example, their 2019 income. Let me just give you an example. Okay. Let's say that we're doing a loan for somebody, and in 2019, their gross income was $120,000. The gross income, not the net income, the gross income. The net income, yes, we have to qualify them based on their net income. But right now, if their gross income was $120,000, that divided by 12 months makes it about $10,000 a month, right? Now, what the new guideline is, they're looking to see, let's say we start an application June 15th. So they want to see the last 2 months, so April and May, if that entity, if that business entity has deposited close to $10,000 in their account or not. Because it basically, they say, well, last year's income was $120,000, $10,000 a month. Have you deposited $10,000 in your account? Now, it's such a brand new rule that we don't know if the guideline, you have to be a stickler at the 10,000, or in my personal opinion, as long as you're close to that income, 7,000, 8,000, I think it should be fine. But if we show 2 bank statements, and in 1 month they have deposited only $2,000 and the other month they deposited $3,000, that would be a difficult deal to be done. So that's why I really want everyone to be aware of, even if you've done a pre-approval a week ago, you're self-employed, that needs to be revisited. And when I say that needs to be revisited, look at what your approximate gross income was in previous year in 2019. So that's the big change that has happened for self-employed borrowers. It's very important. So
that's a good idea. I always encourage my borrowers to go to a lender 6 months before they decide to buy, especially if they're self-employed borrowers.
Yeah. So yes, so if they've gone 6 months ago and they've done the pre-approval, but what I'm saying is if they have to be revisited now because of this change. So everyone needs to be pre-approved, making sure they have the deposits in their account for the last 2 months. Yeah, so that's important. Revisit the pre-approvals for self-employed borrowers.
I see. Okay, thank you for sharing that. Anything else since last week?
No, I think
No?
this is it. It would have changes every week, but you know,
That was the big one, huh?
crossing my fingers that
I
they
know.
won't have any more changes.
Okay, so last but not least, tell us about the rates.
Oh my God. I'm so glad you asked. I think this is the lowest I have seen. If it's not, I mean, I think it's the lowest in the last 22 years that I've been doing this.
Wow.
So I think this is a fantastic time to buy and to refinance. But before giving you the rates, just want to bring out, guys, borrowers, clients, future clients, my friends, it's gotten harder to do loans, but we are doing loans every day. We're doing purchases, we're doing refinances. It's a little bit hectic, so please, when you want to start a refi or purchase, it's only for 30 days. It's going to hurt a little bit, but you're going to be fine. You're going to be happy at the end. Okay, so just want to tell you that from the get-go. Now, let me give you the good news. Conforming low balance. So for all the loans up to $510,000, you're looking at rates of 2.875%. 30-year fixed. These are all with 0 points. Conforming high balance, it goes from $510,000 to $765,000. You're looking at rates of 3.125%. Amazing. FHA low balance up to $510,000. You're looking at rates of 2.25%. There's a 2 in front of it. Okay, 2.25. Conforming high balance, you're looking at 2.75%. Again, conforming for FHA balance from 510 to 765, 2.75%. And jumbo rates, any loans above 765, you're looking at rates of 3.375%. These are amazing rates. If people can take advantage of these, please do.
No, I don't think I've ever heard of 3.125% on conforming high balance ever. That's a fantastic rate. Okay. Well, is there anything else you want to share with us, Edwin?
That's it for now. We'll talk about it next week.
Perfect. Thank you everyone for joining us. Next week, same time, same place, lending talk. If you have any questions about lending, you can call Edwin. Edwin, what's your number?
818-585-8283.
And if you have any real estate related questions, you can call me. You can call someone in my team. You can call me at 818-402-9923. Thanks for joining us, and we'll see you soon.
Bye.
Bye.